Hey everyone, and welcome. If you're just getting started with investing, you've probably thought about some of the big classic industries. And, one question that always pops up is whether it actually makes sense to invest in oil and energy. So, should you? Is this the right moment to add a little splash of oil to your financial strategy? It's a huge topic for sure, and one that has a lot of strong opinions on both sides. But today, we're going to cut right through all that noise and break it down into simple, understandable pieces.
So here's our game plan. We'll kick things off with the absolute basics. Then we'll look at the exciting upsides, the good stuff. After that, we'll face the hard reality of the risks involved, figure out where oil might fit in a smart portfolio, and then wrap it all up with a clear strategy you can actually use.
Okay, first things first. Let's just clear up something people get wrong all the time. When we talk about investing in oil, we are not talking about you getting a giant, messy barrel of crude oil delivered to your front door. Thankfully, the reality is a lot simpler and easier than that.
For most of us, getting exposure to oil really means doing one of three things. The most direct way is just buying shares in those huge household names you already know, like ExxonMobil or BP. A more diversified route is to buy an oil ETF, which is kind of like buying a basket that holds shares from many different energy companies all at once. Or, believe it or not, you might already own some oil stocks without even realizing it, through the energy companies included in broad market index funds.
So what's the big deal? Why do investors get so excited about oil stocks in the first place? Well, there's a powerful allure, and it's really built on some very attractive financial perks. Let's dig into the pros that pull people in.
This really boils it down to four main attractions. First up is strong income. A lot of these companies are just cash machines, paying out a really steady stream of dividends. Second, they can act as a shield against inflation. When the cost of everything else is going up, energy prices often do too. Third, when oil prices are high, these companies can become absolute cash flow monsters, with profits just surging. And finally, they offer a bit of balance. Sometimes when your tech stocks are having a bad day, your energy stocks are doing just fine.
All right, that all sounds pretty great, doesn't it? But as you know, in the world of investing, there is no such thing as a free lunch. For every single one of those upsides, there's a risk you absolutely have to understand. So let's flip the coin over and take a hard look at the reality of investing in oil.
Remember that number one attraction we just talked about? That strong, consistent dividend income? This is, without a doubt, the main reason a lot of investors jump in. But there is a massive catch tied directly to where that income comes from. And this shows the core trade-off perfectly. The pro is those juicy dividends. The con? The whole industry is highly cyclical. The very thing that fuels those big profits and big payouts is also its greatest weakness. So what does cyclical actually mean for you as an investor? It really all comes down to this. Oil is a total boom and bust industry. When the global economy is booming, everyone needs more energy. Demand is high, prices go up, and these companies make a fortune. But when the economy slows down, demand dries up, prices can totally crash, and those profits and your stock prices can fall right along with them.
And the boom and bust cycle isn't the only risk, not by a long shot. You've got the massive long-term pressure from the global shift to renewables. Plus, even the biggest oil giants don't really control the price of their own product. They're pretty much at the mercy of global politics and what OPEC decides to do. And on top of all that, you have growing pressure from regulators and investors who are actively avoiding fossil fuels.
Okay, so now we've got a pretty clear picture of the big upsides and the pretty serious risks. So with this constant tug of war, what's the smart way to think about oil's role in a modern long-term portfolio?
Here's probably the most important mindset shift you can make. It's best to think of oil not as the core of your portfolio, but as a smaller satellite position. It's not the sun that everything else orbits around, it's more like a moon, playing a very specific supporting role.
In this chart here gives you a perfect picture of what we're talking about. See that? The core of your portfolio, the huge slice, should be diversified global stocks, maybe with some bonds for stability. And that energy and oil slice? It's a small, deliberate piece of the pie, usually somewhere in that 5 to 10% range. It's there to add income and diversification without risking your entire portfolio on that wild boom and bust cycle.
And even within that small slice, you still have choices to make. You could go for individual stocks, which might offer a higher dividend, but you're also putting all your eggs for that slice in one company's basket. Or you could choose an energy ETF. The potential payout might be a bit lower, but your risk is spread out across a whole bunch of companies, which is often the safer bet.
All right, let's bring it all home. We've covered the what, the why, and the why nots. So now let's talk about the how. What is the bottom line? What's a sensible strategy for all this?
If you walk away with just one number from this whole explainer, please let it be this one. For an investor who wants that income and a diversification we talked about, a total allocation of 5 to 8% is really considered the sweet spot. It's enough to make a difference, but not so much that a bad turn in the energy cycle is going to wreck your whole portfolio.
So, here it is, your 3-step game plan. Number 1, stick to that 5 to 8% allocation. Number 2, inside that slice, focus on the big, high-quality, established companies known for their strong dividends. And number 3, this is so important, avoid home bias. Don't just load up on oil companies from your own country. Make sure you're diversified globally.
And we'll end on this piece of advice which just sums it all up perfectly. The biggest mistake you can make? Getting tempted by those high dividend numbers and going way too heavy. Chasing that yield without respecting the industry's cycle is the fastest way to get burned. The key, as with all smart investing, is simply balance and moderation. I hope this helps you make a much more informed decision.